Welcome, everybody. We'll be having the session on commodity derivatives. What are derivatives? Derivatives are financial instruments whose values changes in response to a change in a variable called an underlying, which means that it's an instrument. You will price it based on what is happening to the price of an underlying. Underlying is generally the physical or the spot price. However, it can also be the underlying can also be a futures instrument. However, for the time being, derivatives are financial instruments whose value changes in response to a change in a variable called an underlying. And classes of derivatives are forwards, futures, options, and swaps. Now, in which asset classes do you find derivatives? We find them in all the asset classes. For instance, in the commodity markets, we have commodity futures, we have commodity options, we have commodity forwards, and for more commodity swaps. Similarly, in the debt segment, we have interest rate futures and interest rate options and interest rate forwards and interest rate swaps. So we have the asset class changes to the debt market. However, the instruments are the same ones that we referred to earlier. In the forex market, we have currency futures and currency options, currency forwards and currency swaps. So when we talk about currency futures or options, we are basically talking about a currency pair, and hence we are trading in the currency pair, which could be an instrument, a futures instrument, or an options instrument, a forward or a swap. In the capital markets, we have the futures and options. So we have the underlying here would be a stock. And so you can have a stock futures and a stock options, a stock being a name of a corporate, a company which is listed on the capital markets. So what are commodity derivatives? Derivative instruments such as forwards, futures, options, and swaps, which have commodities as the underlying. So we have futures and options, which are standardized forward contracts traded on regulated exchanges such as on the MCX. Forwards, swaps, and options are OTC contracts. They are contractual agreements between two parties outside of an exchange. So just to sum up what I've just said, the four instruments that we talked about, futures, options, forwards, and swaps, futures and options are exchange traded instruments which are based on standardized contracts tradable on an exchange such as MCX. And in addition to that, we have forwards, swaps, and options again. But these options are options which are an OTC options contracts, which are contractual agreements between two parties outside the exchange, and hence they are negotiated. So generally speaking, when we talk about commodity derivatives, we can break them up into these two segments. Why do we require derivatives? Derivatives are required for managing risk. It's important for farmers who are seeking protection against price decrease, or a food processor seeking protection from a price increase. So you can think about it from a point of view of a farmer who wishes to sell a crop 6 months ahead in time, or a food processor who requires a raw material at some time in the future. Both of them are worried that the price might move against them. A farmer thinks that by the time he comes in the market, open market, to sell his produce, the price might fall. And whereas a food processor who requires the raw material, which is a farm produce, is worried that the price might be very high when he requires the raw material in the future. And hence both of them can come to the derivatives market to manage a risk. Manage which risk? Manage price risk. Now, it is also important for manufacturers who are seeking protection against price rise in base metals such as copper, lead, zinc, aluminium, nickel, and so on. So these are manufacturers who are dependent on these raw materials, and the price of their final product, which they make using these raw materials, will get impacted by at what price they procure these raw materials. And hence it is for them as well to come to this futures market or options market, derivative market, when they can hedge their risk, their price risk. Similarly, you may have importers and exporters who are seeking to protect against exchange rate swings. So in other words, even if prices of base metals or any of the food produce does not change uh, per se because of demand and supply, but they might change because of the exchange rate swings. And this risk can also be uh, mitigated, reduced by taking positions on a derivative market. So, what are the objectives of commodity derivatives? There are six objectives laid out here. The first one is risk management. The entire reason why the government allows a commodity exchange to come into existence is so that those who are dealing in these commodities can come to this market and hedge their risk, and they can manage their risk using these financial instruments. On the exchange, we have the commodity futures and the commodity options instruments. Then we have price discovery that is taking place on an exchange platform. What is price discovery? This is the price that is discovered by all the participants in the market. So when the participants in the market start trading, which is buying or selling contracts on an exchange platform, the price that comes out of such trades are considered to be the discovered price. So we have price discovery as an objective of a commodity derivative, and that is one of the advantages of having trade take place on an exchange platform. There is also transactional efficiency. So what is transactional efficiency here? Here is that anyone who has a need to either unload the commodity or buy this commodity, they can use the commodity exchange to uh, enter and exit this market at their as and when it is required. So there is a transactional efficiency here, and also the entire process of trading on a commodity exchange brings in this efficiency. It allows the traders to use the market in an extremely efficient manner. Then there is something called liquidity and savings in the long run. Now, if you did not have a commodity derivative, what would one do? One would perhaps buy the raw material and keep it go down. Or if it were a bullion, then they would keep it in a vault. But they would have to utilize all their savings, all their money to buy the product and keep it in these warehouses and vaults. Now, what that would do would be that the money would be locked up. Now instead they can come and buy a contract in the future, whereby only a small amount of money needs to be paid upfront. For instance, if it is a commodity futures market, a small amount of money gets blocked. That is called margin money. So, for example, margin monies might be in the range of 5 to 7%, which might get blocked. And now the buyer of a commodity who requires a commodity in the future is happy to have the rest of his funds lying with him to use as per his requirements. So all his money does not get blocked. Only a very small percentage gets blocked. If it were an options contract, when a trader buys the right, he buys a right to buy in the future, or buys the right to sell in the future. He has to pay a small amount of money to buy this right, and the rest of the money he will eventually be using it for settling the contract at the expiry of the contract. In the meanwhile, he has liquidity in his hands, and hence liquidity and savings is what he gets in the long run. The fifth point here is a trade guarantee. When you are trading on a commodity exchange platform, there is no counterparty risk, which means that the buyer and seller who are trading in an anonymous manner, when it comes to delivery, if either of the parties, the buyer or a seller, defaults, then the exchange steps in and ensures that the contract is settled amicably. So in case there is a default from the buyer side, then the exchange steps in and buys the goods. And if there's a default from the seller's side, then the exchange will ensure that it will find the right quality of commodity and give it to the buyer. So trades that in this manner are guaranteed by the exchange. There's of course one more thing, the last one here, which is the integration of markets. Now, when I'm trading on a commodity derivatives platform, be it futures or options, then these prices at which I'm buying, these prices are determined by me based on what is happening in all the asset classes. So when I'm trying to find out on what the price might be at a point in time in the future, I'm looking at what is happening in the currency market, what is happening in the capital market, what is happening in the interest rate market. I'm also looking at what might happen in these markets between today and the date of the contract, which is in the future. And hence, I'm assimilating all this information in trying to come to a price that I think might be the price in the future. And hence, anyone who's trades in the commodity derivatives market has to integrate all the information that is coming from various markets. What is an underlying? So we have been using the word underlying. Underlying is basically is the commodity in that commodity asset class. The underlying segments are the bullion, energy, base metal, and agriculture commodities. So when I'm talking about underlying here, I'm talking about this the spot price or the physical market price in the bullion segment, which is so underlying could be silver or gold, or in the energy segment, in the underlying could be base metals. In the energy segment, the underlying could be crude oil, or it could be natural gas, electricity, coal, and in the base metal segment, you could have zinc, lead, copper, nickel, aluminium. Those could be the base metals, which could have these could be the underlying, and hence you look at contracts where you see whether you can find an underlying for it, and then the exchange will launch contracts in these commodity segments. In the agriculture commodities, we have cotton and we have cardamom and we have mentha and rubber, and so these agriculture commodities are the underlyings of these commodities of these instruments. On the option side, on the MCX platform, the commodity futures contracts can also be the underlying. So we have the commodity futures. For instance, in the gold segment, we have an gold options contract where the underlying is the gold futures contract. And for the zinc options contract, we have the zinc futures as the underlying. The prices of derivative instruments, commodity F&O, futures and options, changes with changes in the underlying prices. So whenever we try to price a derivative instrument, we should keep a lookout as to what is happening to the underlying prices. Underlying prices is what I just explained a few seconds ago. So where are derivatives traded? So derivative contracts can be distinguished by the way that they are traded. So over-the-counter derivatives are structured contracts negotiated between two parties. So two parties sit across the table and design a contract which is acceptable to both the parties, and then they trade. That is the OTC, or the over-the-counter derivatives. Similarly, on the exchange side, what is known as the exchange traded derivatives. These are standardized contracts. They are traded on an exchange platform, such as on the MCX. And these trades are anonymous trades, which means that the buyer doesn't know who is selling the contract and the seller doesn't know who is buying the contract. To conclude, commodity derivative markets are an important asset class and it has been in existence for hundreds of years. However, the exchange traded derivative instruments, they were first introduced in the 1970s. And in India, exchange traded derivatives were introduced in the year 2003. Now, derivatives play an important role in price risk management. With that, I conclude. Thank you.